Hi there, everyone, and welcome into this week's market update on the 14th of June. Now, don't forget that any advice contained in this video is general only, so it isn't tailored to your particular circumstances, and you need to decide for yourself whether it's appropriate to you. Alrighty, so our market today broke into bear market territory, okay, for the first time in a very long time. I don't even call the COVID crash a bear market. It was just straight down for a month, right? That was a 50%, 40 odd percent correction on the market. Uh, Really, what we're seeing now is lower peaks and lower troughs, which is something a bit different, right? S&P 500 has displayed signs of this and is also in an official bear market. Nasdaq's been in a bear market for quite some time. As you probably know, listening into my videos, I've been calling, bearish markets for a little bit now. I was expecting this to continue to happen throughout this year. It's always timing's the hard part. But yeah, the CPI reading on Friday was enough to spark another round of selling. So let's get across the charts and have a quick look. Starting off with the XJO, okay, you can see here we tumbled today, right? No surprise, we had the long weekend, so we missed sort of two sessions of the US, one Friday, one last night, where they both fell quite a bit, and we had to play catch up. So, from top to bottom, we're about, 5.3%. We closed the day off at about 3.5%. So no surprise that we saw some buying back up throughout the session, guys. That was a bit extreme, right? Let's jump out and have a quick look. Okay, what are we looking at here, guys? All right, we've got to do this every now and again. Get out longer term and have a look. So you see here that the uptrend overall here broke. Okay, quite some time ago. We went into a channeling pattern, been stuck in that channel pattern, but now we've got a bit of a bear market trend happening. Okay, so lower peak, lower trough now, broken out of the channel, and that's suggesting further downward movement. There's a few things to point out here. Longer term, obviously, you got a triple top across the top here. If you took that into account, you sort of say, well, the XJO could have a target to the downside of around 6,200, 6,200, something around there. Okay, so that's suggesting a further 5, 6, 7% to the lows. Okay, that's what that reversal pattern's indicating. So whether you call it a double top or whatever, approximately around 6,000, 61, 62. Always play thereabouts, guys. Do not get your measuring tape out when doing technical analysis. It's an art form. Okay, don't put your engineer's cap on. Okay. So look, there's targets down there. They're definite potentials, but we also tested one of my key potential targets that I like to look at in times like this as well, and that is the 200-week average. Okay, so flicking out to a 200. So flicking out to a weekly chart here, you can see throughout this uptrend, we've tested this level a number of times. We flew through it from COVID, came straight back above it again. So for it to break, we could have another big sort of correction on our hands, okay, or a bit more of a longer term bear trend on our hands. Last time we spent a lot of time below here was the GFC, okay, so you can see back in the GFC times, we tested that level, rebounded, toyed with it for a few days, broke below, used it as resistance, and then the further sell-off happened. So one or two scenarios here, guys, okay? Could be one of these scenarios where we come down and find it and we just rebound straight away, okay? Or it's going to be one of the scenarios where it toys with it a little bit, or it's going to be a GFC scenario where it's just going to go through, use it as resistance and continue that downtrend. But there's a reflection level here we want to keep an eye on. Because we've fallen so much, the positive futures at the moment, I suspect we'll have a few days up, might come back up, test this downtrend line. Bit of an unproven downtrend acceleration there, but nonetheless, 68, something around there. Normal behavior of the market, I would not be surprised to see that happen, guys. Shoot back up near 68 somewhere, and then a continuation back down, right? Something along those lines is on the table in my mind at the moment. And a lot of it's going to come down to the Fed. So let's talk about the S&P 500. That's clearly broken another key level of support overnight. Okay, so we've gotten through that 39 level. There's no debating that now. If we have a look at this head and shoulders pattern that I've got drawn in here, so shoulder, head, shoulder, we broke through that back here, tested that neckline as resistance and sold straight back off again. This is a very, very clear head and shoulders pattern, guys. There's no debating this pattern for me. It's very clear. That tells me 3,500. Okay, so there's a high chance of that being our next target to the downside. Okay, so if the market keeps falling off, I suspect we'll stop at 35 and have a think. Now, this 35 level is showing up everywhere, guys. That's the head and shoulders pattern. Get across to a weekly. You can see that the 200-week average is also coming in around that level as well. All right, so there's a few sort of technicals that are suggesting that we're going to go and have a play with that. All right, these things are never guaranteed, as you know. Okay, Fibonacci retracements also pointing to around 3,500. So we've got a number of technical confirmation levels. If it hits that, I suspect we'll pause there for a bit and then look for the next bit of information. Okay, if it bounces and breaks the downtrend from there, I will start expecting that to be the bottom, and I'll start adjusting my approach. If it keeps falling through that level, use it as the resistance, I'll stay bearish. So I'm not just looking at that level. I don't try and pick bottoms, guys. Okay, I use these levels as confirmation levels. Okay, if it bounces from that level and this lines up, I go long, right? If it breaks below that level and this lines up, I'll go short. Okay, so these levels are important, but I don't just automatically jump in at those levels. So just be warned, right? Just because it's testing a level that I'm talking about, it doesn't mean I'm getting in and trading it. I'm looking for other signs to suggest that level is going to hold or not. Okay. All right. So they're the technicals at the moment, guys. Everything's suggesting further downward movement in the medium term. In the very short term, it's a bit overbought. So oversold. My apologies. Okay. So I wouldn't be surprised to see a slight rebound before things continue lower, and that's what we're sort of reading on the tea leaves at the moment. All right, so coming back across, what caused the big sell down over the weekend was a higher than expected CPI reading. Many were expecting that this is coming, the fact that this is coming off a higher base, that things might start cooling off a little bit. Well, no. So CPI heavily driven by the energy side of things, I believe. Okay, so this is supply chain issues. Supply can't keep up with energy. You've got many factors going on there. But obviously food prices are being affected by various different things as well. Fertilizers have gone up in price. The whole Russia-Ukraine situation. Ukraine's agricultural industry has been hurt. That affects food prices. There's a whole heap of things that have played out. But from here, what's going to get things to improve will be energy coming back down. If oil prices start falling again, then that's going to take the pressure off. But if crude continues higher, which it has over the last few weeks, even though OPEC met and talked about increasing production, oil still went up. I think that's a massive warning sign here, guys. Okay, so for me, energy sector is what you've got to be watching. Crude, gas prices, that side of things, if that eases off, that's the quickest way for inflation to start coming back down again. Okay, that's not happening. So at this point, we do have an inflation problem, okay, which it could cause a stagflation problem. Now, we haven't seen a stagflation situation for a very, very long time. Most market participants, advisors, traders have never lived through a stagflation situation. You'd have to be something like 80 years old, all right, if to have lived through the last stagflation event. So we're probably a little bit uninformed here. Okay, we've got to watch this. Just think about this a bit more, right? The big problem here outside of stagflation is what the Fed's doing. So there's so much happening, guys, right here. But what sits? Guess what makes me feel a bit uneasy is that this whole stagflation situation is going to end up sending the US to a recession anyway. Australia, maybe not, right? If commodity prices keep going up, we might avoid a official recession. It doesn't mean the everyday person's not going to get squeezed. It doesn't mean that discretionary and technology stocks and banks and other sectors aren't going to get harmed. But what it means is Australia might avoid recession. But the US, the way things are going, the way the inflation's going, they're likely to head into a recession even without the Fed doing anything. Okay. Um, but with the Fed lifting interest rates as well at the same time, well, that's just going to put the pressure on even more. That causes more fear in the market. Okay, that's the big thing. So look, only way we're going to avoid this stagflation situation, really, in my mind, is if energy prices start coming down, if supply chain issues start resolving, right? Don't get me wrong, I still think this is transitory in a sense, right? It's going to take. If I think oil prices can come back down, by the way, right? But it's going to take a lot longer than what people were expecting, and we're probably talking years now, right? Rather than 6 to 8 months, and that's the thing. Okay, so I think this situation is temporary. By the way, this whole situation I think is very temporary. But we're going to have to go through some hard times to get back out to the good times. Okay, so Fed hiking rates now. So obviously this is the flow-on worrying effect of the market. The Fed has not given us any clear path forward here. They have not told us how much they're going to lift rates by. So what's happening here now is everyone keeps speculating on the back of data. Higher CPI reading, oh, the Fed's going to increase rates by 0.7 or by 1. And that could happen, okay? And that's why the market is falling out of the bed, right? Is this complete uncertainty. And the Fed could lift rates on Wednesday by only 0.5%. The market could keep falling if the Fed doesn't give us some level of certainty, right? So the way I'm starting to look at it, guys, is this, right? The bond market's already got rates high. All right, if you're a business and you want to go roll your bond from one maturity out to 5 years, whatever, or your current bond that you bought 3 years ago is coming up to maturity and you're going to do another 3-year bond, guess what? Your new bond's going to be, taken up at a much higher coupon, right? Um, and that's the thing, okay? So you're going to have to be paying the higher interest rate regardless of what the Fed does next, okay? At this point, the Fed's not lifting rates, okay? The bond market's already done that for them, all right? It's just they haven't lifted their official rate. Not much changes, really, okay? For us in Australia, it's a little bit different, okay? RBA lifts and all the variable rates go up. Same thing as in the US, right? But the big difference in the US is a lot of people have long-term fixed loans, okay? Where in Australia here, still a lot of people sitting on variable, right? And the people that have fixed have only fixed for 1, 2, or 3 years, okay? So there's a little bit of a different scenario in the two countries, right? But nonetheless, okay, what difference does it actually make at this point? Does it make that much of a difference to the stock market if rates go up? Because the bond market's already pricing it. So the Fed might as well get it out of the way, right? Scare the market, do what they need to do, get some ammunition back in the barrel so that way, when this stagflation recession hits, they've got the ability then to drop rates again. And when they do drop rates, they'll hopefully bring the bond market with it. Okay, so I think there's a strategy playing out here that we've got to think about. And lifting rates by 1% today and lifting them again 1% for next month, that might actually be good for the stock market. What it means is they get the lift of interest rates out of the way quickly, okay, and that way they can start turning a little bit more neutral to dovish again. Okay, so they can control that narrative. So the quicker they get the pain out of the way, all right, the market might keep falling another 10%, 20%, whatever it does, okay, over the next 2 months. But if they can get it out of the way quickly, the quicker they get it out of the way, the quicker they can then start backpedaling and going back towards a neutral to dovish stance. So I think that's what I believe the strategy is, okay? Lift rates really quick, pull the Band-Aid off, right? Rip that Band-Aid off, get to the point where we're back to a neutral stance or above neutral stance, okay? Sit back and wait see what happens. So for me, I think the Fed could lift by 1. That Thursday morning could lift by 1, right? And I'd actually be okay with that now. I think for me personally, I think I'm a bit over it, right? I think it's getting close to being priced. I think we're closer to the bottom than what we were at the top. You know what I mean? another 10%, so something like that. We fell 10% in 3 days, 4 days. What's another 10%? You know what I mean? Just get it out of the way, get it done, right? Get it done so we can move on. That's my attitude towards it now. So let's see if that attitude comes into the marketplace, right? I might be a good month ahead with this type of view. I'm hearing a few other people maybe leaning towards this direction now. Just get it out of the way. So that could be what happens in the next few months. Is that the Fed might be actually better off now just doing it, just getting it done. Okay, so we can finally move on to the next chapter, which will be, the markets have fallen. Let's start buying in again. So look, I'm not going to pretend I know where the bottom is, guys. None of us do, right? In these situations, where I think the bottom's going to be is where inflation does actually start topping out. For me, I need to see crude to stop rising. I need to see crude oil to sit at a level and pull back and stay lower. We started seeing that for a little while when it was flirting around with that $100 level. I hung around there for a while. But with crude up at 120 and not showing any signs of falling, issues in Libya, there's all these other things that keep propping up. Oil, if that continues to be the theme, then we might be in a bear market for a while. Okay, so there's a few things. Inflation's one of the things we've got to look out for. That's for sure. Okay, uh, and so that really comes down to my next thing. Where is the bottom? Okay, all right. So what we're looking for the bottom of the market, fundamentally, inflation to be topped out, the Fed to have backed off their stance of lifting interest rates, start talking, even just the snippet of some green shoots of being a tiny bit dovish is what we want to see, right? Um, we want to see the yield on the bonds come back and start normalizing a little bit. At the moment, they've inverted. I should have mentioned that earlier. But the 2 and 10 is now inverted as of today in the US. So that's recession signs. I think we all knew that was going to happen. Okay. So I want to see that start coming back to normalization. Okay. Once we see that normalize a little bit. So crude, bond yields normalize. The Fed's sort of hit the top of this rate hiking cycle. Um, crude coming down. I can't say that enough times, right? Crude coming down, crude coming down, crude coming down. They're sort of the main things I'm looking for to start saying, okay, fundamentally, I think the worst is over. The next thing I'm looking for technically is they start to see these really sharp down trend lines to break. I want to see a double bottom. I want to see an inverse head and shoulders. I want to see something technically to suggest that we're finding a base, right? One little bounce is not enough for me. I want to start seeing those higher peaks, higher troughs. I want to start seeing those technical turnaround signals. That sort of says we found the bottom. All right. In these big sort of bear market correction phases, there's usually time to wait it out and just make sure you found that bottom. Who cares if you miss a little bit of the upside, guys? If you are going to try and play the bottom, right, just make sure you've got a good strategy to do it. Don't just throw your money at it, right? I always have a play. Of course, I have a play, right? If I jump in early, I'm only going to be using a very, very small percentage of my bank on the first trade, and I'll leverage it. And if I win, I'll win. If I lose, I'll lose. But when it comes to the portfolio side, okay, I might go in with a small chunk, buy a bit more, just to make sure I've gotten the bottom. Yeah, so it's just about having a good strategy when you're trying to pick the bottom of the market, right? But longer term, guys, look, 5-year outlook still, things will recover. Inflation will get under control. Fed will start stimulating again, get us out of this recession. It's always going to be the same story, right? Rinse and repeat. One of my clients said to me today. So yeah, rinse and repeat, guys. That's what the attitude's going to be in a year or so. All right, so that's where we're at. Look, this is a pretty long video. I just realized what time it is now. So thanks for listening in. If you got this far, big falls at the moment, guys. More on the table in the short term. I think it could be a rough couple of months here. But there is, for me, I think, starting to be a little bit of a light at the end of the tunnel. If they lift rates quickly, get it out of the way quickly, the quicker they do that, the quicker the market will bottom, right? That's what it comes down to. All right, so that's where we're at. Take care and bye for now.